Hey everyone, welcome back to Corporate Decoder, the place where we decode the often crazy world of corporate filings. Today we're diving into a Form 8K from Arthur J. Gallagher & Co. This report isn't about crazy acquisitions or shocking scandals, but more about the boring stuff like loans. But don't worry, we'll make it interesting, or at least try to. Think of it as finding out if your friend just got a bigger credit card limit. It tells you something about where they are and where they are planning to go. So what's this filing about? Arthur J. Gallagher, a big insurance brokerage and risk management company, has essentially refinanced and expanded its credit line. Think of it as getting a new, bigger mortgage on your house, but instead of a house, it's their business. They've amended and restated their existing credit agreement. That sounds technical, but basically they've tweaked the terms of their loan. Let's get into the details. On April 3rd of 2025, they finalized an update to their credit agreement from June of 2023. It's now called the A&R Credit Agreement. Several things changed first. They extended the maturity date. That means the date they have to pay back the loan from June 2028 to April 2030. That gives them more time to manage their finances. Next, they increased the total amount they can borrow. It went up from $1.7 billion to $2.5 billion. That's a big jump. This includes some smaller pots of money specifically for letters of credit, which is like a guarantee and a Euro Swingline sub-facility, which is short-term loans in euros. It also mentions that they might, if they can convince lenders, be able to increase the amount up to $3 billion. Before we get to the analysis, let's quickly cover a formality. The company's stock trades on the New York Stock Exchange under the ticker symbol AJG. Just a standard piece of information in these filings. Now let's dive into what this all really means. Why would a company increase its borrowing capacity by so much? Well, it usually signals a few things. Firstly, it shows that lenders have confidence in the company's ability to repay the debt. Banks don't just hand out billions of dollars without a good reason. Secondly, it gives the company more flexibility. They might be planning acquisitions, buying other companies, or making other big investments. Having that extra credit available means they can act quickly when opportunities arise. The filing mentions that other material terms like financial ratios and the overall cost of borrowing didn't change much. That's good news. It means they got this bigger loan without having to agree to much worse terms. A company's credit rating determines interest rates, so a company with a low credit rating will usually pay more than a company with a high credit rating because the bank is taking a higher risk by loaning to them. If you want to read the exact legal language of this, the full agreement is included as an exhibit to the filing. It's Exhibit 4.1 if you're really into the details. So, what's the takeaway here? Arthur J. Gallagher has strengthened its financial position by securing a larger, longer-term credit facility. This suggests they're confident in their future growth prospects and are preparing to make strategic moves. Now let's put on our Warren Buffett hats and think about what this means for the company. On the positive side, this move provides Gallagher with significant financial firepower. They can now pursue larger acquisitions, expand into new markets, or invest in new technologies without worrying as much about immediate cash constraints. This flexibility can be a major competitive advantage in the fast-moving insurance brokerage industry. However, there are also potential downsides. Taking on more debt always carries risks. If Gallagher's growth plans don't pan out as expected, they could find themselves struggling to repay the loan. Rising interest rates could also make the debt more expensive to service, eating into their profits. It's kind of like when you load up on credit cards thinking you will be able to make the payments, then find out you cannot. It is important to see that the company is not taking on more obligations than they can handle. So let's check the company's financials to find out. I'm scrolling over to the most recent 10K. Okay, let's take a quick peek at their most recent full year financials to get a sense of where they stand. Net revenues were about $10 billion for the year. That's a solid top line number indicating substantial sales. Net earnings were around $1 billion. This indicates strong profitability. As a general rule, a healthy company that is growing is worth investing in. Digging a little deeper, they seem to have a reasonable cash cushion to support their operations. Long-term debt stands at about $7 billion. It's good to keep an eye on this debt because it must be paid back. So with around $1 billion in annual profit, the existing $7 billion long-term debt seems manageable. The increased credit line gives them more flexibility without necessarily pushing them into dangerous territory. But it is crucial to monitor if Gallagher's earnings grow proportionally to justify the increase in debt. If they do not, then this could lead to real problems. The hope is they are growing in such a way that it will dwarf the increased debt load. In conclusion, Arthur J. Gallagher's decision to increase its credit facility is a strategic move that positions them for future growth. While there are inherent risks associated with taking on more debt, the company's strong financial performance suggests they are well equipped to manage it. It will be interesting to see how they deploy this new capital and whether their growth plans materialize as expected. Thanks for watching Corporate Decoder. If you found this analysis helpful, please give us a like, leave a comment and subscribe for more insights into the world of corporate filings. Until next time.